Debt Market Outlook May 2023. We present a matrix detailing some movement in some key market rates, domestic and global, and key events. The Monetary Policy Committee of the RBI met in April and kept the repo rate unchanged at 6.50%, a first pause after a series of rate hikes. The MPC also decided to remain focused on withdrawing accommodation to ensure that inflation progressively aligned with the target while supporting growth. Interestingly, it was a unanimous decision for a rate pause and a 5-1 decision on the continued withdrawal of accommodation stance. The CPI inflation was projected at 5.2% for 2023-24, with Q1 at 5.1%, Q2 at 5.4%, Q3 at 5.4% and Q4 at 5.2%, and risks evenly balanced. The MPC, however, continued to warn, there can be no room for letting down the guard on price stability. The debt markets reacted favorably, and the benchmark 10-year gilt moved down by around 20 basis points, BPS, through the month to close at 7.12%. The entire yield curve across credit and gilts softened by around 20 BPS. The US 10-year gilts remained volatile through the past month and closed at 3.42%, down around 4 BPS through the month. Crude continued its softer bias with concerns about demand arising. Looking ahead, we think the domestic rate cycle is close to its peak. While RBI, after its pause, will continue to maintain vigil over inflation and may have more rate hikes, the markets have largely priced in such rate hikes, should there be any. With RBI projecting inflation of 5% in the second quarter of fiscal 2024, the time is now apt for looking into fixed income products across all duration segments. With commodity prices, crude and agri-commodities softening through the past few months, a sustained commodity slowdown may provide a respite to retail inflation. The bear flattening of the yield curve, especially in the 1 to 5 year segment, has largely happened, hinting at the possible end of the upward movement of the domestic rate trajectory. AAA credit spreads are very tight, and the probability of spreads increasing soon remains a distinct possibility. The US Fed raised interest rates by 0.25 percentage point to the 5.00% to 5.25% range. It signaled that further rate hikes may be unwarranted given the inflation level and signs of a slowdown combined with the risks of a challenging credit scenario. Fed policy action matters for India as RBI may consider appropriate action at the June meeting. What should an investor do? While tax changes have been announced in the debt segment, the merit for debt mutual fund investments continues beyond the tax changes. Investors with a shorter time horizon of less than 1 year may continue investments in ultra-short-term and low-duration funds. Short-term fund category may be suitable for investors looking to stay for a time horizon beyond 1 year with a lower risk volatility. For investors who attempt to capture the interest rate cycle, an allocation to dynamic bond fund merits attention. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.